With more than 6,000 small and micro-cap companies listed, if you're looking for the next apple at the earliest stage, then ChannelChek truly is the orchard. The listed companies support ChannelChek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for ChannelChek so you're always up to date on what's going on at the small and microcap data place. Welcome to SPACtrac, presented by ChannelChek and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on ChannelChek. This program is designed for investors to stay up to date on the progress of special-purpose acquisition companies. Today's interview features Bowlero. Noble Senior Research Analyst Michael Kupinski interviews Bowlero founder and CEO Tom Shannon. Visit channelchek.com or click the link in the description for an exclusive SPAC report on Bowlero and Isos Acquisition Corp, as well as news and advanced market data. And now, here's Michael and Tom.
But before I introduce the management, I would like to give you a little teaser about the company and the industry. Isos Acquisition Corp will be de-SPACing through the acquisition of Bowlero. And I'm hoping that this video may give you some information on how to make a good investment decision about that, but also possibly to change your perception and provide insights into an interesting growth-oriented industry, and that is bowling. Bowling is having a renaissance. It is not the smoke-filled alleys of the past. Today, bowling centers have expanded food menu items, HD TVs, cool lighting, billiards, maybe even laser tag, and arcades, specialty cocktails for the adults. And these are family fun centers. And you may not know this, but bowling is huge. 67 million people in the United States bowled in the past year. That's bigger than any other participatory sports like basketball, golf, or tennis. So if you think about Topgolf is a big thing in family entertainment centers, bowling is bigger and it's growing. So let's meet the management. So Tom Shannon is the CEO of Bowlero, and that is the target company that we're talking about here. And so Tom, welcome. Thanks for being with us today.
Thank you. It's my pleasure.
Tom, there's a very interesting background video by Bloomberg on you, which how you started in the bowling business, which can be found on YouTube. But I would like for you to maybe tell your side of the story and maybe tell the viewers how you got started and what excited you about getting into the bowling industry.
Well, sure. So I got out of business school in '92, and I moved to New York in '93 with the idea of either buying a business or starting one. And I was looking at a variety of different things. And as it turned out, I got invited to a birthday party at a bowling alley. And so I pulled out my little tourist map. I was fairly new to New York, and I took the subway down to Union Square, and I went into this really sort of decrepit old bowling alley where everything was either fake wood paneling or painted gray. And it was like clearly had been untouched and unloved for decades. But it was large, it was in a great location, and it was reasonably busy. So I immediately started looking around and thinking about the economics of bowling. How much was a game, and thus how much revenue was derived from every ball thrown? And I started doing the math in my head, and I thought, this is pretty interesting. I wonder what would happen if you made this relevant to, a modern consumer, as opposed to just this obsolete, harvested thing. And I've always loved to bowl. I think a lot of people love to bowl. As you mentioned, 67 million participants. That's more than 3 times golf. So I was able to acquire the center for $3,000 down and about $2 million borrowed, believe it or not. I only had $3,000 of equity, so that's where it came from. And we didn't have enough money to ever close, so we would renovate during the day, we would clean up, and then open at night. And this went on for about 18 months. However, it worked. The transformation that we made took revenue in that center from $1 million a year to $15 million within those same 4 walls. And so we knew we had something interesting here. The question was, would it travel? And we had the opportunity to test that thesis by acquiring a closed bowling center in Bethesda, Maryland, which is right on the Washington, D.C. border. And it had been owned by a public company, was doing $830,000 a year prior to it losing its lease, which is why it closed, and losing money on $830,000. We took it, we renovated it for about $3 million, reopened, and it did $4.2 million and over $1.1 million of EBITDA in the first year. And we said, okay, if bowling works in Manhattan, if bowling works in Bethesda, Maryland, it works. So we started building around the country. In Silicon Valley, California, Orange County, California, another flagship in Times Square, in Miami. And then in 2012, AMF, which was the largest bowling operator in the world, went bankrupt. In 2013, we reverse merged into AMF, took them out of bankruptcy. And overnight, we went from 6 bowling centers to 272, and from 300 associates to almost 10,000. We effectuated a comprehensive turnaround of AMF, took out $30 million of cost in the first year, set about growing revenue, repositioning the portfolio by reinvesting. Revenue started increasing, profitability exploded. And within 15 months, we had acquired the number 2 player in the world, which was Brunswick, in a corporate carve-out from the parent, 85 more bowling centers for $270 million. And then we embarked on a process of rationalization, buying and building quality assets, shedding ones that weren't so good. And here we are. We're almost 25. We've been profitable from the start, which is maybe a little bit unusual in the SPAC world. Next year, we're projecting revenues of about $860 million and EBITDA of around $285 million. So very high margin business. And one of the reasons it's so high margin is there's no variable cost to a game of bowling or shoe rental. So roughly 70% of our revenue has no cost of goods sold. And so you get very high margins and very high returns on investment. And then lastly, I think an important point to note is that even though we're the biggest player in the US at about 330 current locations, we only have about 8% market share. The US bowling market is highly fragmented. There are 3,500 independent mom and pop centers out there. And so we're in the process of acquiring some of those. We're building new. In fact, in the last 60 days, we acquired 23 locations. We built and opened 2, and we acquired the land under 2 we were leasing. So we're very active in acquisitions, we're active building, and we're acquiring real estate that we're currently leasing. So there are a lot of growth vectors. It's an exciting business. It's a great business that no one pays attention to, and I think that'll probably change once we're public. But it's been a very, very good run so far.
Well, it's an amazing story, and I'm going to back up a little bit and kind of go down and drill down a little bit here in a little more detail. The company has 2 operating divisions. It has a leisure division, which is the bowling centers, and then you have a media division. So let's first concentrate on the leisure division. I think you have roughly, 321 bowling centers now, and I think you continue to buy more. But not all of your centers are upgraded to the new formats, but you get very attractive returns on upgrading your existing facilities, which would seem that would be a great growth story, just updating your currently owned facilities that are not updated. So maybe can you give us a little color on the returns you see on upgraded centers?
Sure, Michael. Well, we've upgraded a lot. So there are about 182 that haven't been upgraded to what we call the experiential spec. That's the Bowlero brand. But not all of those will, because there is a role for traditional bowling, and that's our AMF brand. It's more sport focused, so more league heavy, more traditional. And so those centers might be in areas where you don't have enough density of population or affluence to justify the investment to go to experiential. Of those 182, roughly 90 remain to be renovated, and they have the potential to go to experiential. So you're right, 90 is a lot, and you're probably talking another incremental $2 million per center once they're renovated. So that's another $180 million of revenue tailwind. You get a tripling of EBITDA of those locations on a doubling of revenue typically, and over 41 conversions that we've done, they've averaged a 37% return on investment. So it's a great growth vector by itself, and in addition to building new and buying.
One of the interesting things about the bowling centers is that there's organic growth, and like we were talking, I mentioned Topgolf, which many of these businesses only grow by adding new facilities, but bowling in itself, these centers actually show organic growth. And I was just wondering if you could just talk about that dynamic and what your experience has been in terms of just the organic growth in bowling.
Well, you have increases both in walk-in traffic and in price that aggregate to, over the last 7 years, a compound same-store sales growth of 4.9% for the company, which is, I think, pretty good. So yeah, bowling is a growing business. We've gotten a nice tailwind. The markets we're in tend to be the better markets, the larger markets that are growing. There's a lot of different revenue components to what we do. There's, of course, bowling and shoe rental, but also the arcade business that we've been investing in. So when we acquired AMF, they used to outsource all of their amusements to third-party providers on a revenue share basis. And we realized that that was a very good business. We've taken that in-house. We've done 168 arcades, and they have about a 66% ROI, and they drop revenue at a 90% EBITDA margin. So a great business. There's still about 80 of our locations that yet to have arcades. So in addition to the renovations we just spoke about, there are also arcades that can go in. And then we do food and beverage. And we don't get overly ambitious with the menus because the customers aren't really looking for that. What they want is good basic stuff: burgers, pizza, chicken wings, mozzarella sticks, etc. We get more ambitious than that on the corporate party menus, but we try and stay very focused in terms of maintaining a very good food cost, which tends to be in the mid 20% range, a beverage cost in the low 20 to say 22% range. And so even though these are not as high margin as the core bowling and shoe rental business, they're still very high margin businesses and very profitable. But we view food and beverage as an adjunct to the core bowling business. We are fundamentally in the bowling business. Our average center is 40,000 square feet and 40 lanes. And that's quite a differentiator versus some of the other boutique concepts that have come and gone, frankly, over the years, that did a handful of lanes and really focused on food and beverage. The best part of the bowling center business is the bowling. And we've never lost sight of that. And we like bigger bowling alleys.
And Tom, you mentioned about the roll-up opportunity, and obviously the company is by far the leader in the number of centers, 8 times the number of your closest competitor like Lucky Strike. What is driving your acquisition appetite for more centers at this point?
Well, we've always been highly acquisitive, right? I mean, we acquired AMF, we acquired Brunswick, and then recently we acquired Bowl America, which was a chain of 17 centers in the Washington, D.C. area predominantly. We have always been on the lookout for quality independence. I would say that the events of the last 18 months have made more of those proprietors willing sellers. And there are a couple of reasons. One is the average age of these proprietors tends to be in the mid-70s. So they're at the natural point in their life where they would be sellers of assets. And then, the uncertainty that was injected into all of our lives in the last 18 months has, I think, caused people who would never be a seller of these assets to say, hey, maybe the risk, the discount rate here is not zero, right? Maybe owning these is not risk-free. And maybe now is a good time to take the chips off the table. So we've seen about a quadrupling of deal flow now versus pre-COVID, and much higher quality assets are available now than were before. And the same thing is true, by the way, of building new. We only go into A locations. You get to cherry pick when you're building new. And so we like to go into malls, really good malls, or into cities with fantastic locations. And what's happened is a freeing up of retail space, and a desire on the part of landlords, particularly the larger mall operators, to increase their leisure tendency and to decrease their reliance on traditional retail. And so all of these things have really inured to our benefit. We're seeing really good deal flow and high volumes of deal flow and acquisitions and on new builds.
And your experience on those acquisitions have been pretty favorable. Can you talk a little bit about the dynamics of the multiples you're paying and the returns that you're seeing as you've made these acquisitions?
Certainly. So we'll pay anywhere from 5 to 10 times trailing EBITDA or EBITDAR, as the case may be, if it comes with the real estate. But we have a very evolved, very sophisticated, and very comprehensive operating methodology, which enables us to take the existing industry EBITDAR margin of about 20% and almost instantaneously increase that to 40%. We then get another 10% EBITDAR margin through investments, maybe an arcade, an upgrading, an enhancement in the kitchen so we can broaden the menu, what have you. But when you double the margin in very short order and without meaningful capital expenditures, you've now halved on a forward basis the multiple you're paying. And so we tend to pay on a forward basis sub 5, in many cases 3 or 4. And so right off the bat, you're getting very good returns, and that's before any leverage. So if you're acquiring a center with the land, you could put a cheap mortgage on it, for example, and goose that return even higher. You could do sale leasebacks, of which we've done about $270 million worth of sale leasebacks since 2014. But that arbitrage, that ability to manage the asset better, really enables you to buy them at a pretty bargain price going forward.
And you mentioned about the real estate. Let's just talk a little bit about that, because I don't know that people really recognize the value of the real estate portfolio. And I was wondering if you could talk a little bit about what are options that you can to unlock the hidden value of your real estate.
Well, currently we own about 35 centers, give or take, including the land. And the company's going out at about 9 times forward EBITDA. That's how it was priced in the SPAC, which is frankly a bargain. If you look at other companies in the leisure space, like Vail, I believe they traded 18 times. Topgolf got sold at 19 times. And our economics and returns are significantly better than Topgolf's. And our market size in terms of consumers is triple that of Topgolf. So to go out at 9 times forward is extremely cheap. Nevertheless, what we have is, with these centers, the ability to pay rent to them and spin them off either in the sale leaseback market or to create our own OpCo-PropCo structure and spin it off that way. And what happens is, when you look at these as to how the rent would be valued on a cap rate basis versus how the profits are valued on a multiple of operating profit basis, you go from about 9 times forward, as we discussed, to about 17 times. And we think that those assets could pay about $25 million worth of rent, maybe more, but let's just call it 25. And the difference between the 17 multiple and the 9 multiple, the difference between a cap rate multiple and an operating multiple, is 8. So right now there is an embedded arbitrage of 8 times that $25 million of rent, or $200 million of incremental value that could be unlocked simply by paying rent on those assets and flipping them into the sale leaseback market or what have you. That value isn't reflected anywhere. It's not on the balance sheet. It's not in the income statement. But that's just sort of incremental value that the buyer of the stock is going to get. The other thing is, we have $350 million worth of tax loss carry forwards that we got when we took AMF out of bankruptcy. And so the company is not going to be a taxpayer anytime soon, which is, certainly very attractive. And so there are a lot of attributes and aspects of this company beyond the core bowling business that make it interesting and attractive.
And Tom, what also I like about your company is that it's how you manage the business. Your data-centric software management tool you call QMS Can you describe QMS and the opportunity it provides to optimize your business? And I believe that you have a plan to offer this as a SaaS model to other businesses as well. Can you talk a little bit about the opportunity there?
Yeah, so QMS, which by the way, we recently renamed Bellum, short for cerebellum, and it's a more catchy name, so we'll call it by its new name, Bellum. We started developing this really back in 2014 when we needed some way of comparing all of our centers on a margin basis and figuring out how do we optimize their performance, because we had a large number. By 2014, we were well over 300 locations. And what we started doing is looking at peer sets, revenue peer sets. How are these doing the centers doing relative to one another in various revenue categories that were key drivers and in various expense categories, and benchmarking them throughout all of these categories. And what ends up happening is you find what the optimum performance is of a center in a given revenue bucket in terms of revenue potential, profit potential, margin. And that becomes the bogey that everyone shoots for. So the company has always had this philosophy of complete data transparency. All of our general managers are able to see the revenue, profit, margin, and various accounts of every other center in the company. We took that data transparency and we utilized it to create this very intuitive, easy to use system called Bellum. It works at the enterprise level. So if you're looking at it from the C-suite, you can see very quickly, how are we doing in aggregate? How are we doing on a regional basis? How are we doing it in more specific geographies, or at the center level? How are we doing it by regional manager, et cetera? The general managers go in, and this is the most significant. They immediately know what good performance is. So let's say you have a $3 million center. If you didn't have this data transparency and you didn't have this tool Bellum, you wouldn't really know what a good EBITDA margin is. And we use EBITDA because we own the dirt under many of our centers, and thus there is no rent. And a lot of our rents are sort of artificially applied. They're not market representative. So we want everyone to look strictly at the operating profit margin of the business. That's why we use EBITDA. You have a $3 million center. What's a good EBITDA margin? Is it 20%? Is it 30%? 50%? You don't really know until you look at this and you see that the best performer in your revenue group is doing 57%, which might be 10 points better than you're doing. And that the theoretical optimum performance would be 62%. And so there's a very clear roadmap by category as to how you increase your margin and your profitability. Our general managers are very competitive and they like to compete with each other to be the winners. And what's quite remarkable is when you go and visit one of our centers, invariably the GM will know and probably volunteer what their EBITDA margin is. Now, this is in stark contrast to most leisure and hospitality businesses, where when we interview managers, they don't even know what the revenue is of the facility they're working in. I mean, there is no data transparency in leisure and hospitality for the most part, much less any understanding of EBITDA or margin, et cetera. So we have an ownership culture. We push data down, we push accountability down, and a reward structure down. And these general managers act as CEOs of their business. The district managers act as CEOs of their districts, and on and on. And the combination of the culture, the transparency, and the tool Bellum has given us a 50% average center level EBITDA margin in an industry where the average is 20%. It's a game changer.
So I'd like to kind of shift our focus now on the media sector. It's, I think, one of the hidden gems of the company, given that there's so much opportunities. You own the PBA, the Professional Bowlers Association. Obviously, aside from media rights for televised bowling tournaments, there is a developing sportsbook opportunity with Fox Bet and possibly another sports betting partner. In addition, you have gaming, esports, insider gaming experiences. With so much opportunity, where are you channeling your focus at this time in your media segment?
Well, I'll tell you the real value of the PBA, which we acquired about 3 years ago. Um, It had been starved of investment as a property. The prize funds were inadequate. There was no character development. The sets were mediocre. And so we've infused a lot of money and energy into it. And with success, we've brought the caliber of the sets, up to a much higher level. We have characters who really show their personalities more. We've increased sponsorship dramatically. We have big name sponsors now, like Kia, for example. The real benefit of PBA is that it serves as an infomercial for the sport. So a lot of people see it, watch it. I have people call or text me on the weekends and say, "Hey, I'm in a restaurant or I'm in a bar and bowling is on." And I'm like, "Absolutely, that's great." And what happened is, we acquired it for a relatively modest amount of money. We put money into it, but there are various components. There's betting, as you mentioned. There's the sponsorship, there are media rights, and there's also membership. So it's a growing membership organization. And this year, PBA will make about $1 million a year in profit, which isn't a lot of money. It's better than losing money, certainly. But the real value is that it enabled us to reduce our advertising budget, our traditional marketing spend, by about $10 million. And so it really is benefiting us to the tune of about $11 million. And the reason is we produce 70 hours of original content, mostly for Fox, also for CBS. But with re-airs, those show almost 1,000 hours a year. So think about it. We control 1,000 hours of effectively an infomercial for bowling, where we're featuring our brands very prominently. They're usually shot in our centers. And so the viewer sees AMF and or Bowlero, depending on which center it's in. That's the value of the PBA. I would say the most interesting opportunity in gamification is something that we're doing now. We have something called the PBA Global Showdown, which is a linked virtual tournament where you can enter up to you can play 99 sets of 2 games and enter your best 2-game set to compete for $50,000 in prizes. And right now, there are over 13,000 participants in 27 countries. And when we did this, this is the second one. The one we did in the spring, we had 5,000 participants who bowled in excess of like 80,000 hours in center. It's now gone from 5,000 to 13,000. In addition to being something that's really interesting and rewarding for those bowlers, it also serves as a beta test for this technology of linking all the lanes and showing the scoring in real time. And here's the ultimate manifestation of it. Our goal within the next 12 months is to have the technology in center and an interface, and it might be on a kiosk or it might be on an app on your phone, where you can step up to the foul line and we'll say, Michael, your odds of bowling a strike are X. Would you like to wager $1, $5, $10, $20? And you take the bet and you bowl an 8. And we say, okay, Michael, here are your odds on picking up the spare. Would you like to bet, right? And this will serve, I think, to increase engagement and stickiness and recurring customer visits to the point where it's entirely foreseeable this could be a 20% increase in revenue in center, which would result in about a 50% increase in EBITDA. So this is the game changer. There hasn't been any meaningful innovation in bowling from a technology standpoint since automatic scoring in the 70s, which was a game changer for the sport. And prior to that was the automatic pin setter, which was also a game changer for the sport back in the 50s. Both of those technologies resulted in an explosion of bowling popularity. I see this as the same thing. And we have a proprietary relationship, or will shortly, with the provider of this technology. And so it will be the only centers in the US that have this. And that, think about one extrapolation of that. We view Saturday night as bowling night in America. We want to own Saturday night in the mind of the consumer. And we are very busy now on Saturday nights. You have 13,000 lanes, give or take. Call it 4 people on a lane, you're at about 52,000 people bowling simultaneously. And all the scores are linked through the software, and we say, welcome to Bowlero, welcome to Bowling Night in America, sponsored by Kia. The next lane that has a cumulative 267 pinfall wins a new Kia. Start bowling. Okay? Or whatever tournament we want, any idea can be sponsored by an airline, by Home Depot, you name it. You get the point. We're able to link all of this activity, sponsor it, and Bowlero will be the only place that you can go and win these prizes. So what does that do in terms of aggregating market share? So there are a lot of really exciting things on the come. I think that this in-center linked gaming or gambling, skill-based gambling, I think has enormous potential for our business.
I totally agree with that. I'm not so sure how I would bet, but I know how my friends would bet who knows how I bowl, whether or not I pick up that spare or not. So, but anyway, so I want to kind of go back to the company's recent reported quarter. Obviously, the results came in better than expected. It led for you to increase your adjusted EBITDA guidance for calendar year 2022 from 275 million to 285 million. And in your investor presentation, you outlined steps on how to achieve that level. But can you just talk a little bit about what are the key drivers to this strong growth in EBITDA that you're looking for year over year from 2021 to 2022?
Well, fundamentally, it's increased customer demand, right? So I think we beat guidance or expectations by revenue by 2%, but EBITDA by 14%, right? And so because of the operating leverage in this business, you get tremendous flow through. We're seeing significantly increased customer demand, both in terms of volume and in terms of in-center spend. And so we've taken a discount in terms of modeling it going forward, a discount to the experience of the last year or so, and projected. But we were able to revise our projections higher. And then the other thing is that we're accelerating our acquisition activity. So as I mentioned, we've acquired 23 existing centers and opened 2 new ones, and then acquired the dirt under 2 leased ones in the past 60 days. We have about 30 more centers in the pipeline, mostly acquisitions, but also some new builds. So we're accelerating our inorganic growth, our external growth, at the same time that our organic growth has accelerated.
Gotcha. And so let's talk a little bit about the balance sheet post-acquisition, what it will look like. And also, if you obviously have talked about the strong cash flow. And I also think that you've talked a little bit about your conversion rates of that cash flow in the range of 40 to 45%, which means you could generate 125 million in free cash flow. If you could talk a little bit about that. And then in addition to your capital allocation, and talk a little bit about how you plan to allocate that capital to fuel the growth of the company.
Well, the cash flow conversion is actually better. So we have mandatory principal and interest payments that call it $55 million a year as a placeholder. And then we have required maintenance CapEx of about 12 million. So you're talking 67 million. So if you subtract 67 million from 285, you end up with, I don't know, what, 220, give or take. Historically, we've reinvested all of our free cash flow in growth. And I expect that to continue sort of indefinitely because we have so many good opportunities. High IRR opportunities to acquire, to build new, and to renovate. And so we'll funnel all of that cash flow into growth as long as those good return opportunities exist.
And Tom, can you give us a little bit of an update on the timetable for the de-SPACing at this point? And then also talk a little bit about how many shares outstanding and who might be the owners following the de-SPACing?
Sure. So we're still in the SEC review period. They've provided comments twice. We've responded twice. The ball is in their court. Hopefully, we are getting close to that. And the goal would be to finalize that process and have the shareholder vote in the next 30 days, if not sooner. And so that's sort of what we're envisioning. There are 175 million shares outstanding at DSPAC, and I will own roughly 35%. Our existing partner Ateros will own roughly 32%, and then we have a number of other shareholders. We have Apollo and Soros who are leading the pipe with meaningful investments. But I've never sold a share actually and put money in my pocket. I've sold shares to facilitate growth, but I've never actually sold a share and profited from it. And I'm not selling any shares now. So I'm a long-term bull in the company. I think our prospects have never been brighter. We have so many exciting initiatives on the table in combination with really strong existing performance. It's a really exciting place to be.
And it has to be a little frustrating to see the stock not reacting to all of the good news at Bowlero. In addition, you mentioned earlier about the peer valuations, and if you look at my research report on ISOS, the valuations discounts, I mean the premiums on your peers are 60% above the implied value that Bowlero has at this point. And in the comp tables in the report, the stock would trade at least 45% higher. That's just to get in line with its peers. But as you mentioned before, there's reasons that it should trade at higher than its peer group average multiples, given your better growth profile. So what are your thoughts about the stock valuation? What do you think would be the catalyst toward higher values for your stock?
Well, it is frustrating, I won't lie. When we embarked on the process in January, SPACs were hot, and that seemed like the way to go. And then SPACs got very cold. And, I think the discerning investor is able to look at a SPAC simply as a conduit to going public, and really should be no different than an IPO or direct listing. That's how we view it. And any of those were viable, and we could have gone that route, IPO or direct listing. Ultimately, I think that the value gets realized once you're public. What happens is the shareholder base evolves. You get people see the name and they understand what it is, because right now the non-sophisticated or non-institutional investor doesn't know that ISOS is really Bowlero or will be soon. Okay, so there's a natural following that exists once you're public and the name is changed, which we changed the ticker to BOWL, and I think will be much more widely known. But this does present a really attractive opportunity for people who realize what the valuation discount is now, and it's solely driven because I think you have our sense is that people who know the story are buying the stock now, okay? But you have a lot of SPAC holders who are simply arbitrageurs who are selling into that strength. So the stock has moved up. Recently, it's traded over 10 consistently, which is a really good sign, but it's astonishingly cheap on a forward multiple basis or even a trailing multiple basis, as you point out. So look, it's an inefficiency that presents a great opportunity to a investor who understands the story and realizes that, don't view it as a SPAC, view it as a company.
And I think that is a good spot to end on that high note. Tom, I'd like to thank you for your time today. If you would like to learn more about ISOS, which is the ISOS Acquisition Corp, the stock symbol is ISOS, and of course the opportunities at Bowlero, I would encourage you to take a look at my recent research report on the company, which can be found on channelchek.com. And again, that's under the symbol ISOS. With that, Thank you again. Thanks, Tom. I appreciate it.
Thank you, Michael.
Thank you for joining us for this SPACtrac presentation, brought to you by ChannelChek. Visit our YouTube channel for more special purpose acquisition company content, as well as C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access reports, news, and advanced market data on this and the more than 6,000 companies listed.